hedge fund in the world, and one of the few investors. Thank you, Ray, for being here.
Hi.
Hi, good to see you. And we're going to try to make this an interactive conversation. So we're going to have mics around the room for those of you who have questions. I have some questions that I want to start this conversation on. And actually, it's something that we hadn't talked about at all. And this is just completely random. Have you invested in Bitcoins at all?
No.
Would you?
I would not invest in them. I need to understand them better.
Did you feel like that helped at all?
That did. I thought that was great.
Okay, because I
think
that
there's a lot of merit behind it, and currencies is my thing.
Right.
So I think there's a lot of merit behind it.
But you haven't done it yet.
But it has. That's a whole conversation.
That is a whole conversation. What I wanted to do today is talk really about the way Ray Dalio thinks about the economy and thinks about investing. And for those of you who haven't had an opportunity to do it, I actually wrote a column about this a while back. Ray put out a video about what he describes as the economic machine. You can watch it on YouTube, and you should if you haven't already. That really walks through the way he thinks about the economy, and it is truly different, I think, than most economists would. And I'm hoping to draw you out a little bit on that, because I think it would be instructive for everybody here to try to understand what that model looks like. And I want to read you something. This is from Alan Greenspan, and a lot of people have a lot of different views about Alan Greenspan. But going into the financial crisis, or after the financial crisis rather, he said this about it. He said, the Fed model was as advanced as you could possibly get. All the new concepts with every theoretical advance was embodied in that model. Rational expectations, monetarism, all sorts of sophisticated means of thinking about how the economics worked. The whole period upset my view of how the world worked. The models failed at a time when we needed them most. J.P. Morgan had the American economy accelerating 3 days before the collapse of Lehman Brothers. Their model failed. The Fed model failed. The IMF model failed. Your model didn't fail. What is it? What does it look like? And to the extent that everyone in this room can have the same type of success that you've had, give us the sort of, not the 30-minute version, since we can watch that on YouTube, but the sort of couple-minute version.
Okay. By the way, the reason I did it is because I am worried about future failures of understanding some of the basics. I think there's a problem. Everybody has an opinion, what's going to happen next, and all of this, and they don't spend enough time reaching an agreement of how the machine works. And the economy does work like a machine. There are cause-effect relationships that are very clear. So I urge anybody who's interested in this to spend the 30 minutes. It's on economicprinciples.org. I ask you to do that. But anyway, I'll try to describe it in 3 minutes or 5 minutes. So the economy really isn't complex. Everything is a transaction. And if you look at a transaction, there are just a lot of transactions. But if you look at a transaction, you can pay with money or you can pay with credit. And there are different buyers and there are different sellers. So the buyers spend money or credit. Therefore, spending is going to affect the price. If you spend money or you spend credit, it doesn't make a difference. So when we start to think about monetary policy and you have a contraction in credit and you have a pickup in money that is going to be spent, will that be inflationary or not? No, it won't be inflationary if the amount of spending remains the same. So we can produce credit out of thin air. If you and I agree that you're going to paint my house and I say I'm going to pay you later, we've created credit. And so demand can increase, spending can increase. And with spending increasing, production increases. And you can go through a credit cycle. You typically do go through a credit cycle because your demand is not limited by your production because credit can be created. So let's say I earn $100,000 a year and I don't have any debt. I can go to the bank and borrow $10,000. I can spend $110,000. Because I can spend $110,000, my $110,000 of spending is your $110,000 of income. And because you have $110,000 in income, you can go to the bank and you can get more credit. And asset prices go up because we buy things, and income levels rise. And so that goes on over a period of time. And our debt rises relative to our income. This is the main lesson of this, by the way.
And you do this, though, when you get into a crisis, eventually.
Well, your debt can't rise relative to your income indefinitely. And so if you look at each of the participants, you have to look at each of the participants in this transaction. So I think a big problem of economics is it treats the market as one thing, like there's one buyer. And you talk about it. You on the media, you'll talk about what do you think the market thinks? Well, it's not true. There are different buyers for different motivations, and they behave in different ways. That's logical. And if you look at it transaction by transaction, you can understand those motivations. For example, a mutual fund, public, will tend to sell after the price goes down because they get bearish. Whereas a pension fund...
You're saying if a mutual fund goes down...
the average retail investor gets scared. And so he'll have a pattern to sell. Whereas a pension fund will have a pattern to rebalance. So that they'll buy when prices go down. I'm saying that when you look at each of...
But how do I, I'm trying to understand this, and if I'm an investor out there and I'm trying to look at the world the way you are, how do I put it in sort of a real world context? If I'm sitting there thinking I should be getting into the market or out of the market based on, or stock market or bond market for that matter, based on what you're saying.
So I think let's take the markets as an example, then we'll give an example. When you had a financial crisis, naturally the Federal Reserve produces money because the Federal Reserve can only buy financial assets and they can only produce money. Mm-hmm. And that money goes to make a certain type of purchase. And that alleviates a liquidity problem. As a result, cash rates become low, non-existent, and have a negative return. And people then make those purchases of bonds and other safe assets for safety. But when you're producing liquidity, and then there's a big difference in the expected return or the yields of cash versus other assets, first bonds, cash becomes low, bonds have a higher yield. And if you understand the behavior of the players, most of the investors are motivated by a yield spread. So if you inject safety, this was, let's say, a year ago, if you're injecting liquidity and producing safety, and you produce a yield spread, that yield spread is going to mean that there's going to be an increased buying, moving out on the yield curve, and riskier assets, equities that have higher expected yield, and that will drive down those yields. As those yields get driven down, the asset prices rise. And so what we see is then asset prices rising, which also drives down expected returns. So we're now in a position, if you look at the transactions, in which you say, who are the players? The Federal Reserve can do certain things. It can buy those assets. It can produce only a wealth effect. Right. It can't buy goods and services. So now, who gets the cash when they buy that? That means that so what we've gone through now is that as assets go up in value, the expected future returns go down. This now will have a big effect on the Federal Reserve's capacity to influence.
Okay, well, let me ask you
about... You could see those things if you watch the transactions.
Okay, so let me ask you this, just to bring it back to layman's terms. Where are we now? And when you said that the Federal Reserve, for example, doesn't have as much firepower, at least that seems to be the suggestion. Right now we have the Federal Reserve continuing to print lots of money. Is that working? Does that make sense to you?
It's working with consistently decreasing effect, and it will work with even less effect. So, and I could explain mechanistically why that is.
Well explain. Why, but not just why, but then therefore the question is, what happens as a result?
Okay, I'd like to emphasize the machine. Mm-hmm. And why? Because if I go just to the conclusion, then I'm just going to give you conclusions, and we won't talk about how the machine works. It's like, I'd rather give a man the ability to fish than to give him the fish.
Okay, so, try to help us fish then.
Okay, what I'm saying is, the Federal Reserve, there are three ways usually that the Federal Reserve is stimulative. They normally lower interest rates. When they normally lower interest rates, it affects everyone because you buy your cars, they're cheaper on time, and so on. Now the Federal Reserve can only produce the purchases of financial assets. That has an effect of causing a wealth effect. The wealth effect requires a trickle down. So the rate at which it trickles down has diminishing effects. As we cause this wealth effect, it's concentrated in the hands of those who have those financial assets. And the things that they buy will be like the things they own. They're going to buy other similar financial assets. And as a result, the spending in the stores has a diminished effect. In addition, what happens is as that price rises, the expected future return goes down. So for example, the expected future return of equities is about 4% a year now because of the price rise. In other words, I think over the next 10 years, equities will have about a 4% return. When you have a 4% return now, expected return, and the standard deviation of equities is about 18%, as you lower the expected return and you do not lower the expected risk of equities, then increasingly there is a movement more to cash. So as you have a greater appreciation in the price because of that, you have less wealth effect, and each increment of wealth effect has less impact on spending.
You have argued, watching the video and reading some of the writings, that we could be on the cusp, depending on how this all goes, of social unrest that looks like what happened in Germany.
Well, this is if you go into a depression. If what happens is there's always a cycle. These things have happened over and over and over again, and there's a part of a cycle, like it's happening to some extent in Southern Europe, where debt is a promise to deliver money. And when there's not enough money, and the central bank doesn't print enough money, and you have that pain, then you have social tension. That's the only thing I'm saying. So the Federal Reserve has done, in my opinion, a masterful job of providing liquidity to alleviate the debt crisis and to bring us to a particular point. Fantastic. We have almost normalcy. But if we were to have a downturn again, and then you were not to be able to rectify that downturn in some way, and central banks responding quickly by their actions is key, then of course you have social tensions like we experienced in 2008 and 9, social class tensions.
So when you talk about the different debt cycles, long-term and short-term debt cycles, what are we in now?
Well,
you're always your machine.
You're always in both. In terms of let's say the short-term debt cycle, we are right in the middle of that cycle. We have gone from, let's use the term, we've gone from, let's call it a recession, in terms of point where now if you look at operating rates and most things, we're in the middle part of that cycle. Unlike the late part of the cycle, in which the late part of the cycle is when the economy is growing fast and you're out of capacity and the central bank should tighten monetary policy. So the cycle, we're just crossing the line, kind of right at the line of the middle part of that cycle. In terms of the long-term debt cycle, we have a very high debt to GDP, which is coming down gradually. And it's coming down, the key to it coming down is to keep nominal interest rates below the nominal growth rate, because debt will compound by the nominal interest rate. And so what's been happening with the Federal Reserve and so on is they've run monetary policy in a way that nominal growth in other words, growth in income, is greater than the burden of interest on compounding that debt. And that's allowed our debt to GDP ratio, or debt to income ratios as a whole, to come down gradually, but there's still a lot of indebtedness. That higher level of indebtedness means there's a greater interest rate sensitivity. Federal Reserve will not be able to raise interest rates for a number of years, for many years. So any tightening will just be a reduction in essentially the
So are we Japan?
Financial assets.
You said that 4% was what you thought for the next 10 years?
Yeah.
So if you're a pension fund, or frankly, if you're an investor, what do you do?
Well, so this is when all assets have gone now to, I wouldn't say that they're too high levels, but they've gone to high levels. In other words, what is a 4% return? Okay, that's relative to a bond. It's okay, it's pretty good. Relative to cash, it's better than cash. But as they are squeezing that down, there is the choice of those low returning assets. And so then the question is, what do you need money for? And do you have a liability? And how much risk do you take? I think the most important thing of an investor is to create the proper balance of those investments. In other words, I think that going forward, most investors are not going to be able to produce alpha. Alpha is a zero sum. We have 1,500 people that work there with computers doing all sorts of work, and it's the pros against that. So that alpha is a very difficult game. I would say most investors should create a balanced portfolio against that, but it's a difficult situation.
Okay, I just want to read, I was trying to look for some critical views of your machine, and I found this on a website, and I just want to read it to you and get your reaction, and then I want to open it up to the audience. Ray essentially defines a beautiful deleveraging, and I don't know if you've used the phrase today yet, but you talk about this idea of a beautiful deleveraging, that actually what's happening so far is actually okay, as one in which the system stays intact, regardless of whether some are getting crushed by deflation and others are getting crushed by inflation. Unfortunately, pain is not distributed very evenly. It's not obvious to me, for example, that this utopian view of a deleveraging within such a supercycle can occur without the upheavals that he wishes to avoid, nor should it.
Well, I guess I'll state how a beautiful deleveraging is, or what I mean. A deleveraging means that you have your debt to income that's too high. And that happens to individuals, happens to companies. And there are three ways that you can get rid of that. You can either have austerity, and when you have austerity, that means you spend a lot less to bring down and pay off your debts. Right. You have to pay off. When you do that, the problem is one man's spending is another man's income. And so that reduces the income, and the cycle continues to go on. That's deflationary, and it reduces income, and it produces that problem, but it's part of the process. Second way you can deal with it is to restructure debt. In other words, it was $100, and now you write it down to $50, and you can do that by stretching out interest payments and doing all sorts of things. But the problem with that is one man's debts are another man's assets. And so when you write down that debt, you also have a negative wealth effect that has a problem. The third way you can do that is to print money. Printing money is inflationary, all things being equal, because it increases the demand. The key is to do that in a balanced way. In other words, we've had a lot of history. Right. This isn't theory. We've had a lot of cases in which countries have had too much debt and then had to lower their debt to GDP ratios. How do they lower their debt to GDP ratios? There are ugly ways of doing it. That's what we talked about, the ugly deleveraging. The beautiful way of doing it, meaning in the balanced way, is to do the first two, which are deflationary and negative in growth, in a way that's balanced with the printing of money, which is inflationary, so you achieve a balance. So if you look at what's happened really since 2008 and 9, we've had a beautiful deleveraging. There have been restructurings, there's been a change in balance sheets, there's been the printing of money. You always have to print money, it always happens. Interest rates reach zero. Did not produce inflation. Did not produce inflation. So the achieving of that balance with nominal growth rates above nominal inflation rates is the way beautiful deleveragings happen, and that can happen in a balanced way.
Okay, one more question before we go to the audience, which is this, because we're going to take this conversation from being a high-level conversation about the economy to something very different, which is that may be one of your great reasons for your success, this economic machine that you've just described. But the other thing that we've talked about privately a lot is that you meditate every single day, and you believe that your meditation is one of the great reasons for your success. What is it that you do? Well, and by the way, you're not the only one who's doing it. Dan Loeb, who we're going to see in a moment, he's doing it. A lot of people in the hedge fund.
You're doing it.
And you got me doing it, so I've tried it.
And you were just saying to me when we came out.
This is true. Before I came out, I not today, but yesterday, I did it. I tried to use it to go to sleep because I was anxious and nervous about today's conference.
So what happens with meditation, as you know, is it's just a simple exercise that allows you first to clear your head and then brings an equanimity to everything. Everything, it eliminates the stress, it eliminates the emotion.
And you do it how often? You're a busy guy.
Yeah, I've been doing it for 44 years, but I do it, twice a day, probably a third of the time, once a day, probably a third of the time, and not at all.
For 20 minutes, twice a day.
Yeah.
So you spend 40 minutes a day as part of your...
Oh, it's such a great investment. I would say that more than any other factor having any effect on my success, it's been meditation. Because the equanimity and also the creativity, because it opens between literally the prefrontal cortex and the amygdala, it opens the two sides of the brains and it allows a spontaneity, a creativity, an open-mindedness. And so it's good for not only the health, because you get stress is a terrible thing, but it also is very good in terms of the clarity, and you don't get the emotional hijacking, and it's great for creativity. So it's helped me a lot. It's the biggest gift I can give anyone.
Okay, so if you didn't understand the economic stuff, meditate. Let's open it up to the audience. I think we have a couple of mics in the audience, and hopefully there's some questions for Ray. Right here.
Hi, I'm Adam Gold. If this was 1975, do you think you would start Bridgewater again? Is that something that is possible in today's market with technology and all the participants?
Oh yeah, sure. I think, I think it really comes down to your inventiveness. It's like saying if Steve Jobs, Bill Gates, is the world open for Steve Jobs and Bill Gateses? It's just a matter of imagination. I think that the one thing that I'm trying to convey in that video is that it really is all simple, and if you can kind of distill things down and you get the insights, you've got the ability to do that. So, yeah.
A question right back here.
I want to add to that, though there's no reason necessarily to do that if you can be working at a place that allows you to be yourself and to flourish. I mean, we could talk about culture. I think the most important consideration that you have in your picking your job is who you're going to be with, and are you in a culture that's complementary so that you can flourish and be yourself. It doesn't have to be in a company or out of a company. It doesn't have to be your own.
I know there's a lot going on behind the all-weather fund, but basically, it seems like the portfolio leverages up bonds at a time when pretty much everyone thinks interest rates are headed up. How is that a good idea to sell to pension funds? Thanks.
So just to clarify, there is no bias to bonds in it. What happens is the all-weather fund, or the way I think a balance, is that want to put about the same amount of risk into different asset classes. And then what happens in stocks is that stocks have a volatility that is more than twice of bonds. And as a result, if you had a 50-50 stock bond portfolio, you'd really have about twice your risk in equities. It would be dominated by equities. So if you take a bond and you either buy a very long duration bond or you leverage that bond, what you will be able to do is get 50-50 of your risk in bonds and stocks. So there are four pieces to an all-weather fund. There are assets that do well in rising inflation environments and assets that do well in falling inflation environments. So a bond will tend to do well in a falling inflation environment. And commodities and inflation index bonds will tend to do well in a rising inflation environment. And then there are assets that do well in a rising growth environment, and then assets that do well in a falling growth environment. Because the markets discount expectations, and then they change and they move those around. And so it is not concentrated in bonds in terms of risk basis. And you could see that in terms of the 70s. If you look at the 1970s and say, how did all-weather do in the 1970s, which was a decade of rising inflation, and a period that was very bad for bonds, the portfolio did very well. And that's just because it's balanced. But it looks like it has more bonds because you have to increase the quantity of your bonds to balance the fact that they have lower volatility.
Why don't we try to sneak in one or two more questions? Alex.
Hi, Alex Stevenson. I'm with DealBook. You recently said at a conference at the Japan Center that you thought France might be a place where the next crisis might first emerge. I wonder if you still feel that way, and how you think it might look, a crisis that starts with France.
Okay, so again, everything that I'm saying just comes from that 30-minute template. And what it means is that as debt rise faster than income, which is continuing in France, and interest rates, both the base rate and the credit spreads, have gone down to a certain level that they can't decline anymore, there's going to be a rise in debt service payments in France. And those rise in debt service payments are going to have an increasing constrictive nature on the economy. It's going to start to hurt that particular economy. At the same time, there's the rollover of debt. a lot more debt needs to be rolled over because it builds up and compounds. And when it becomes more difficult, it's going to be more difficult to roll over that debt. And as that debt becomes more difficult to roll over, it starts to produce a funding gap, and it produces wider credit spreads. Wider credit spreads, in turn, make the debt service payments more problematic, and that process begins. So I think that it is a development, it is a factor which will happen. I think that in terms of changing the landscape, it's put France in the category of Southern European countries. So now we have Southern European countries, and we have Germany and some small Northern European countries. So it's changed the dynamic of the euro, and it's changed the dynamic of the ECB, because the ECB has 23 votes, and if you look at how the votes are, what kind of monetary policy should the ECB run? It should represent that which represents all of Europe and those votes, and France's circumstances have changed that to put it in a way to have a looser monetary policy and a more accommodated policy, more at the isolation of Germany. So I think that those are the main implications.
On that note, we have to leave the conversation, but I want to thank you, Ray, for the economics lesson and meditation.
Thank you. That was great.
Thank you.
That was great. Appreciate it. Bye-bye.